Hi, I'm Doug Goldstein with Profile Investment Services. Today I want to answer the question, what do I need to know about investing in stocks? My disclaimer for this, of course, is even though we're going to talk about stocks today, they're not for everybody, and be sure that you speak to a licensed financial advisor before you do any investing. The number one question you have to ask is, should I be in stocks at all? A lot of people go into the stock market one way or the other, which we'll talk about in a second, and they don't even belong there. They don't have the tolerance for risk, meaning the volatility drives them crazy, and maybe it doesn't even fit in with their long-term goals. Another myth that people have, and it really bugs me, is when people say, Doug, I only want to buy safe stocks. I don't know of a single safe stock. I have been in the business for decades. I've traded millions and millions and millions of dollars worth of stocks, and I don't know one that's safe. Maybe there are companies that are good companies or that have good long-term prospects, but to me the word safe means you can't lose money. And anytime you put your money in stocks, yes, you can lose money. There are four main ways that people invest in the stock market. Either they'll buy individual stocks, or they will buy an ETF, an exchange-traded fund, like an index fund, or they'll buy a mutual fund, or they'll have a money manager handle the portfolio. So let's dive in. I'm going to present a presentation. This is a real nuts and bolts, roll up your sleeve kind of presentation. I'm going to jump to the other side of the computer screen so I can show you the presentation. So let's look together and see if buying stocks is appropriate for you and what's a good way to do it. Let's dive right in and see what is it that I need to know about investing in stocks. In this conversation, I'm not going to talk to you about how to predict the stock market because, frankly, my prophecy is very weak and I don't really know what's going to happen in the future. But I'll tell you the four common ways that people enter the stock market. I'm hoping that you'll be familiar with them, and then I'm going to go into depth on one of them because I think it might be a little bit newer. Possibly the most common method that people are familiar with is simply buying individual stocks. We've seen it in the movies, maybe we've done it ourselves, maybe someone once called you and said, hey, Mr. Jones, I'd like you to buy 1,000 shares of XYZ stock. And, it's at $20 a share, and you buy it, and it goes up or down, and it's very exciting. And frankly, that's really the exciting part of the stock market. People love talking about the stories. That's one idea. Another way that people get into the market is they will buy ETFs, exchange-traded funds. Generally, what we're talking about here are index funds. And the idea is that if you don't know what stock to pick, or you don't want to try to predict it, or you don't think that anyone could predict the market, you just want to be in the market. You want to do what the stock market does, for good or for bad. You could buy an index fund that trades on an exchange, and so it's called an exchange-traded fund. It has the risks of the market, but it is more diversified than buying an individual stock. They usually trade pretty regularly, so you can buy and sell it all day. In fact, there are professional traders who only trade in ETFs. A lot of the people I know who are professional managers only use ETFs rather than individual stocks. Another choice is to buy a mutual fund. A mutual fund is just a basket, and inside the basket, everyone puts his money, and the managers buy a whole portfolio. Let's say it's a stock fund, they'll buy stocks, and you own a piece of the pie. So whatever the managers do, you get a piece of the profits, or you'll, of course, lose if they lose money in the account. And you're paying fees for the managers to run the portfolio. Usually mutual funds are a little more expensive, the internal fees, than ETFs, than exchange-traded funds, and all the money you're paying in the fees obviously is not money that you're keeping for yourself. So we have to look at the different choices. There are pros and cons to everything. The fact is, it's a big argument on Wall Street. There are people who have very, very strong opinions. I think there's room for all of these in a portfolio, depending on who you are and what your situation is, your goals, and your tolerance for risk. Oh, I didn't mention the last thing, which is big and bold in the middle of the screen. What's a managed account? A managed account is a portfolio of stocks or bonds or ETFs, exchange-traded funds, where the managers will buy a portfolio. Now, when I'm talking about managers, I'm talking about institutional level managers. I'm not talking about where you walk into your local bank or brokerage firm and someone says, hey, Tony, he's our manager. He'll trade your stock portfolio for you. I'm talking about institutional level money managers who normally trade money for endowments or pension plans. They're very, very serious companies. Frankly, normally to be a client of one of these companies, you might have to walk in with $1 million or $5 or $10 million just to meet their minimum. However, through brokerage firms like ours, we participate in certain platforms that match these institutional level money managers with individual clients. And then you could choose the type of manager you want. A domestic manager, large cap, small cap, bond. These are just a few of the possibilities. And depending on the amount of money you're investing, you might choose several different managers to handle different parts of your portfolio. It sounds a lot like a mutual fund, doesn't it? Because you're putting your money in and there are people who are managing it, and you hope that they do a pretty good job. So let's just compare. In many ways, they're similar. They're both managed by professional money managers. They're always looking for new ways to do better. They each usually have a pretty clear objective, which I think is important. You want to know how your money is going to be invested. And normally you can compare them against some sort of benchmark or an index to make sure that at least you can see that you're achieving your goals. So that's some of the similarities. Basically, it's professionally managed and usually diversified. Differences, however, in a managed account, you own the individual securities. Why is this important? This has a certain tax benefit. If you buy something and sell it for a gain, you have to pay tax on that profit. If you buy a mutual fund and inside that fund, they've been holding a stock for 10 years, and then they sell it a month after you buy the fund, all of that gain that they made gets credited to your tax return. So people sometimes get very surprised. They buy a fund and all of a sudden they have a big tax, even though they didn't make the money. Compare that to a managed account where you have no embedded gains because the day you start, the money managers buy the individual securities just for you. Not only that, you always know exactly how you're invested, and you don't always know that with a mutual fund. Usually you learn, could be twice a year, or monthly, or quarterly, depending on the type of fund, what investments they have. People like to know what they own. Another benefit of a managed account is that if there's a certain area you don't want to invest in, sometimes people say, well, I don't want to invest in sin stocks, tobacco or alcohol. You can tell a manager to not invest in a specific area, whereas with a mutual fund, that's not possible. You can't call them up and say, hey, I think you guys should not be buying XYZ stock because I don't like their morals. So you get to keep more of what you earn because of the tax benefit. You can find yourself in a pretty difficult situation sometimes with mutual funds. Not always, but sometimes, and something you have to be aware of. And with managed accounts, that won't happen because each of the securities that is bought in your own name. You're not pooled together with other investors. It's also useful if you're trying to set up a very diversified portfolio, which, frankly, when people try to do it themselves with individual stocks, it's hard to do it. Who has expertise in every field? But money managers often have investment committees that do the research, or depending on the size of the account, you might have several different money managers who specialize in different areas. So it's easier to do a better asset allocation to divide your money in different areas when you use managed money. Who's it for? Normally, managed money accounts start with $100,000 or more. If taxes are a concern for you, if you're looking for broad diversification, if you're not the type of person who wants to check your investments all the time, but you still want to have some control, you want to be able to say, I don't want to own this, or I do want to own that. Or, for example, at the end of the year, let's say you have another account where you have a lot of capital gains and you're going to pay tax. You could tell your money manager, look through the portfolio that you're managing, see if there are any losses there, and sell those losses so I can offset those losses against gains I have somewhere else. A lot of times, if people have inherited a lot of money or sold a business or just gotten a huge amount of money and they want to get it working for them, they'll go straight to a money manager because their job is to deploy those assets. Like if you roll over a retirement plan, if you had a 401k at work and now you roll it into an IRA, you can have a money manager handle that for you. Everything gets started right away and is managed in a professional manner. Naturally, it's not a guarantee. Just because they're professionals and they diversify and they know about asset allocation and they do research and they trade the account, no one can guarantee anything, but it certainly sounds to me like it's a good idea for a lot of people. If you're a long-term investor and you have certain goals, consider using managed accounts as part of your overall investment plan.